Hi candidates, welcome to another session of Manifested Online Classes. We are still soldiering on with the topic number 6, and in this particular session I want us to look on one of the subtopic from that topic number 6, which is on materiality guidelines for financial reporting. So when talk about the materiality, basically we are talking of the significance, or basically we are talking of the importance of a financial information as far as decision making is concerned. So mean that if an item is important, if an item is significant as far as the decision making by the users is concerned, then in that particular case we can say such an item or such information is material. Such information is material, and therefore materiality guidelines for financial reporting basically helps the entity in terms of determining those items which are material and which must be included in the financial statement to be prepared, because by the end of the day, if they are not included in those particular financial statements, automatically they will affect the decisions now which are to be made by who? By the users of the financial statement. So therefore, first of all, we can say that materiality guidelines, materiality guidelines helps entities in determining the material items to be included in the financial statements, statement. So materiality guideline will help the entities to determine the items, or basically the information which is to be included in the financial report, or basically the financial statement, because if that particular information is not included there, then you are saying that may adversely affect the decision which will be made by users of those financial reports or the users of those particular financial statements. And also recall here we have said that when talk about the materiality, we have said that this is the significance or the importance of financial information the significance or basically importance of financial information in decision making. So if an item in this case we have said is material, and therefore is likely to influence, is likely to affect the decision which will be made by the users of the financial report or the users of the financial information, then basically you have said such information is said to be material. But on the other hand, if information will not affect the decision to be made by the users of the financial statement, then we say such information is immaterial, and therefore such information do not necessarily need to be included in the financial report or basically the financial statement to be prepared by an entity, because by the end of the day it will not influence, it will not affect the decision now to be made by the users of who? The users of the financial statement, the users of who? Of the financial statement. Maybe we can further proceed and we define the materiality concept in details. Let's look on the definition of materiality concept. Definition of materiality. Definition of materiality concept. Concept. So already we have said that materiality comes from the word material, and basically you have said materiality is what? Is the significance, or basically is the importance of a financial information as far as decision making is what is a concern. So therefore, we can say that materiality can be defined to be what? Materiality can be defined. Materiality can be defined to be the significance or the importance of financial information in decision making process. In decision making a process, and therefore we can proceed and we say that financial information which is likely to influence the user's decision is material, and as such it must be included in the financial statements, or basically it must be included in the financial reports prepared by the company at the end of the year. So therefore, that information which is likely to influence, or basically which is likely to affect the decision which will be made by the user, we are saying that information is material. So anytime the company is preparing the financial statement, that information must be included there. Otherwise, if the company prepare a financial statement and such information which is material is omitted, then we can say that this particular financial report, this particular financial statement which are prepared, then they are misleading because they do not contain information which is basically material. Which is what? Which is material. Now, in this case, the number of factors which determines whether an item is material or not. In determining whether a financial information is material or not, the number of factors which may determine that. So therefore, we can look on the factors influencing the materiality. Factors influencing materiality of financial information. So which are some of the factors which determines whether a financial information is material or not? So number one, we have the nature and the magnitude, magnitude of the transaction. The nature and the magnitude of what? Of the transaction, or basically we can talk of nature and the magnitude of the item. So when we talk about the nature and the magnitude, we are referring to the amount which involved in a certain transaction. The amount involved in a certain transaction. Generally, large transactions, or basically those transactions which involve huge amount of money, then we say that they are material. They are material because if they are omitted in the financial statements which will be prepared, then we can say that those particular financial statements are misleading because the decision which will be made by the user of the financial statement will be affected by the fact that there is a huge transaction, or basically there is a transaction which involves huge amount of money which was omitted from those particular financial statements. So therefore, here when talk about the nature and the magnitude, we are talking of the amount involved. We are talking of the amount involved. Like in this case, if we have two transactions, a transaction involving 2 million, a transaction involving shillings 200, then we can say that this transaction here is material. It involves huge amount of money. So if it's omitted from the financial statement, then the financial statement, we can say that they will be what? They will be misleading. They will be what? Misleading. But if this particular transaction, for example, is omitted, then the decision which will be made by the user may not be affected, because you can see this is an insignificant amount. Insignificant what? Amount. So the other factor which determines whether financial information is material or not is something called the legal and regulatory requirements. The legal and regulatory requirements. Legal and regulatory requirements. So when we talk about the legal and regulatory requirement, there are those particular transactions which are supposed to be disclosed by companies in their financial statements, irrespective of the amount involved. Irrespective of the amount involved. For example, in accordance with the International Accounting Standard number 24, which deals with the related party disclosures, any transaction between an entity and a related party has to be disclosed irrespective of the amount involved. Irrespective of the amount involved. So therefore, all the related party disclosures, irrespective of the amount, we say that they are material. They are what? Material. Because if the company do not disclose those particular transactions, then we can say that the financial statements prepared do not comply with the these particular standards, because the related party transactions were not what? Were not disclosed. So therefore, the other factor which determines whether an item is material, whether financial information is material, is the legal and also the regulatory requirement. Any financial information which need to be disclosed by a certain accounting standard, by the regulatory requirement, we say is material irrespective of the amount. Irrespective of what? Of the amount. Now, the other factor which also determines whether an item is material or not is what we refer as the user's need and expectation. The user's need and what? The expectation. We can talk of the user's needs and what? And the expectation. The user's need and the expectation. So when talk about the user's need, we are talking of what the users of the financial statements are interested in the financial statements. Are interested in the financial statement. So therefore, the user's need and expectation determines the materiality of an item. So if, for example, maybe there is some information which the shareholders of the company, which the potential investors want to see in the financial statement, and that information has not been disclosed, irrespective of the amount involved, then we can say that that item is material, because the shareholder, the potential investor, has not been able to see that item he was expecting to see from the financial report. So therefore, the decision which he will make will be affected by the fact that that item has not been what? Disclosed, has not been disclosed. So the other factor which also determines the materiality is something called the entity's specific consideration. The entity's specific consideration. Entities specific consideration. Entities specific what? Consideration. So in this case, when we talk about the entities specific consideration, we say that each entity should consider its unique circumstance. Its unique circumstance, what we refer as the industry norm and the reporting practice. And the reporting what? Practice. So it means that there are those particular financial information which must be disclosed by certain companies operating in certain what? Industries. And therefore, if such items are not disclosed, irrespective of the amount involved, then we say that those financial statements which were prepared by such a company are misleading, and therefore they are likely to affect the decision which will be made by the users of those particular financial what? Statements. So therefore, in this case, we have this as actually some of the factors which determines whether an item is material or not. And therefore, in this case, we are saying if an item which is already considered to be material is not disclosed in the financial statement, then those financial statements we are saying may be deemed to be misleading because they will negatively affect, they will influence the decision which will be made by who, which will be made by the users. So then in this case we can proceed and look on the application of this materiality concept. So let's look on the application of the materiality concept. Application of materiality concept. So in this case, materiality concept may be applied in various ways. So number one, you can talk of something called the qualitative materiality. Qualitative materiality. So basically when we talk about the qualitative materiality, this entails determining whether financial information is material or not by looking on the impact of that particular information on the decision to be made by the users. So mean that if the information will affect the users decision, then in this case we say it is material, irrespective of the amount involved. But if a financial information will not affect the decision to be made by the users, then in such a case we say it is what is immaterial. So therefore, under what refers as the qualitative materiality, so here we look on the effect. We look on the effect, or basically the impact of financial information on the user's decision. On the user's what? Decision. So in that case, we are saying if an item or financial information will affect the user's decision is material. If it will not affect the user's decision, then we say it is immaterial. So the other way in terms of how this concept is applied, we can talk of quantitative materiality. And basically in this case, when we talk about the quantitative materiality, this entails expressing financial information, or basically entails expressing items in financial statement as a percentage of a certain key financial metric, as a percentage of a certain key financial metric. For example, an expense can be expressed as a percentage of the profit after tax. Of the profit after what? After tax. And in this case, for example, an organization may have decided that if the percentage gotten is 5% or more, 5% or more, then such an expense is said to be material. But if the percentage gotten, say, is less than 5%, then that expense may be deemed to be what? To be material. So therefore, when talk about the quantitative materiality, this basically entails determining the materiality of an item, or basically financial information, by expressing it as a percentage of a key financial metric within the company's financial what? Statement. And then from there we have something called a tolerable error rate. Tolerable error rate. When talk about tolerable error, mostly this is used by the auditor. So basically a tolerable error is an error which is acceptable. For example, if there was an error which was made and maybe the profit was overstated with 2%, 1%, so the auditor may determine an error which is acceptable, because by the end of the day, once the financial statements have been prepared, they may not be 100% correct. So, but there is that error which is acceptable. So therefore, here an item may be deemed to be material, or will be deemed now to be material if maybe the margin of error exceed or is outside the tolerable error. But if the error which was made is within the acceptable error rate, then in that case we can say it is not material. It is not what? Material. So therefore, these are basically various concepts which are used by entities to determine whether an item is material or not. And actually we are saying that this particular concept is very, very important because it helps entities in terms of determining which information must be included in the financial what? In the financial report, or which must be included in the financial what? Statement based on their impact on the decisions which will be made by the various users. So basically that brings us to the end of that particular subtopic. But before we wind up, I want to give some assignment. I give an assignment here. So the first question, explain the concept of materiality. Number one, explain materiality concept. Materiality concept in financial reporting. In financial reporting. Financial reporting. Number two, discuss the factors that determines whether an item within financial statements is material or not. Is material or not. So therefore, we have those two questions from this particular topic, or basically regarding what we have been able to discuss on materiality guidelines on financial reporting. So basically that brings us to the end of that particular subtopic. See you in the next session.